So after opening almost half a percentage point lower, Indian market witnessed a smart rally and rebounded amid a buying interest in index heavyweight stocks like Reliance, HUL and Infosys. Now at close, Sensex reclaimed the 65,400 levels and was up about 0.14% to close at 65,415 levels. Now it touched an intraday high of 65,517 and an intraday low of 64,821. Now the 50 share Nifty on the other hand closed flat at 19,434 levels above its long time support of 19,300. Now the index touched an intraday high of 19,465 and an intraday low of 19,257. Now the small cap and the mid cap index on the other hand were underperformers in today's session. The majority of the gains was seen in the small cap space, which was down about 0.73%, and the mid cap space also ended lower about 0.17% at 37,770 levels.
All right, so let's quickly get in our guest Gaurang Shah, Senior VP, Geojit Financial Services, into this conversation. Gaurang, thanks very much for taking time out. I want to understand what's happening in the markets today.
Well, Shweta, I think our view on the markets for the last fortnight is that we are in a brief period of consolidation, and that consolidation zone, if you will, on the Nifty spot is somewhere around 19,300 or thereabouts on the lower side, where we've been twice, once this morning and earlier, I think about a fortnight back, we went and visited those levels. And on the higher side, 19,500 to 19,600 is the zone where you will start feeling a little bit of top heavy feeling. Short to medium term, you might see traders coming and wanting to book out. And more or less, I think from the highs that we saw of 19,991.85 a couple of weeks back to these levels where we saw this morning sub 19,300, the correction of approximately 3.5% if I stand to be corrected. And if my calculation is going right. So, we are possibly in a consolidation zone, and I think it is good that we are spending this time in this consolidation zone. It basically gives an opportunity to the market to make a strong base, wherein in the next move upwards in the future, it will be easy to withstand those higher levels that we'll be visiting. And the market has a history, Shweta. Whenever we've gone and touched a new all-time high, market's tendency and nature is to consolidate for some time.
So, Gaurang, the rebound that we saw, was it a technical pullback or was there a fundamental trigger?
I think short term, there is anything fundamentally that has changed for the market. In fact, the fact that long term, and not to forget, after seeing a rally, again, I stand to be corrected if my numbers and my memory serves me right. I think on 30th of June, we were at, 19,000? Correct me if I'm wrong. And in the month of July, you saw a rally which gave you an up move close to about 1,000 points. Almost we were there, but we missed it out by about 8 points. So after seeing this kind of a rally of almost about 990 odd points, I think you should not complain about some period of consolidation. I think it is just a brief consolidation in an otherwise long-term bull market.
Fair enough. My question then would be, even as that run-up in the month of July happened, many called the markets quote-unquote overheated and said that there was an imminent correction just around the corner. Can we look at what's happened over the last couple of weeks as the beginning of that correction, considering certain pain points are going to continue? The interest rate scenario, high inflation both in India and the US, those issues will continue to affect sentiment for the foreseeable future.
So I will call this as a short-term turbulence, Krishna Kumar, in an otherwise very stable flight to safety and an upward move. Inflation is high, there is no doubt about it. And we discussed it in our earlier program as well, that vegetables, certain food grains are creating a short-term turbulence in the market, wherein there is a little bit of uncomfortable feeling. Interest rates, I think we have to bless ourselves that we are in the third time we are in a pause with respect to the credit policy. I'm not too worried about what happens in the US or UK or otherwise, because they have got a different set of problem to handle and they're at a very different kind of a situation than what we are in. So we are much better placed in the governor's own word last week. We are in a much better place and a much better position to deal with situation in case if there is something untoward has to happen, Krishna Kumar. I think earnings season was something that the market was looking forward to. There is curtain downs over there. So, my sense is that these interest rates and inflations are just some short-term speed breakers or turbulences in an otherwise a very positive market.
Gaurang, you seem to be really optimistic, because from the reading of what the governor said, he said appears that inflation is going to be a pain point in the upcoming months ahead. El Nino could be one of the reasons why headline inflation continues to be above what the RBI and the government was expecting, has been revised upward to 5.4% from 5.1%. You seem very upbeat that inflation will be tamed.
Well, Shweta, if you really go to see in the last 3-4 days, tomato prices have come down from, I think, 160 to maybe about 120 or 80 rupees. So, these kind of, and I think it is only prudent on the MPC committee, monetary policy committee or governor's part to pay up a little bit cautious and then possibly make statements. My sense is that if you're not looking at next 3 to 6 months, I'm talking about the stock market and the index or the Sensex or the Nifty where they are. If you have a longish time horizon, I think there are enough opportunities that are there where you can possibly go and nibble into the market. We are seeing some signs of easing off. I think once we have a little bit of more stability, and I think what the kind of havoc the rain is creating in certain parts of India, I hope that is not very detrimental, and I hope there is no such serious damage to the food crop that was standing. Some of it might have got washed out, there is no doubt about it, the kind of rainfall that we've had. But provided that we have a stable situation, and if numbers don't inch up, which I'm hoping that it doesn't inch up, then I think we should be in a much more better situation.
Right, Gaurang, the intention behind me asking that question is very simple. For those waiting to time their entry to the markets, there's never a good time to enter the markets. Even those out there who are buying mutual funds, blue chip mutual funds, or SIPs over there, they say if they're looking for a good window, and if you're hoping for a dip in the future as a good window to sort of reinvest or add to your investments or add to your portfolio, is that dip coming? Are we going to go any lower than where we've gone in the last couple of weeks? Are you looking at a little bit more downside in the coming weeks?
Krishna Kumar, after 2008, I learned one thing, that there is nothing called impossible in the market, because when a developed economy like US could have such a huge problem and have a cascading effect on the equity markets across the globe, I think anything, and in equity markets, anything and everything is possible. I'm not saying that whatever 3.5% correction that we've seen is it. There is a possibility, and our markets or any markets are exposed to all kind of internal and external risk. Now, if there is some geopolitical situation, if there is a natural calamity, if there is a dangerous threat to the crude oil supply pipelines across the globe, there might be a little bit of more pain in the market. No denying about that. But whether we are capable of overcoming that, which I am quite sure we are. So this correction that we have seen, and to answer your question, I think if you are waiting in the sideline, then at least take a plunge of 25-30% of whatever capital you want to invest, whether it is either direct equity or whether you want to go in for a blue chip mutual fund or a balanced fund or whatever be it, or if you have a little bit of elevated risk appetite, go into the small cap and the mid caps of the world. But just go ahead and make that initial plunge. I'm not saying go all guns out and put all your money at one time. Market has given you an opportunity. I think you should encash upon that opportunity.
The opportunity, there is an opportunity, a great window there for that matter for those planning to enter market. Gaurang, we would have loved to continue this discussion, but unfortunately I'm going to have to cut this short. Thanks very much for joining with your insights. We hope to get you back very, very soon. Shifting focus now, India is at a cusp of change. Fundamentally, our economy is strong. Macros continue to be robust. Global uncertainty hasn't impacted India in a manner that it has many developing countries and developed countries, as various brokerages, global banks and institutions have reiterated. 76 years since independence, India is primed to be the third largest economy in the world by the turn of the decade. Now, India has a long path to traverse, and to decode broader economic parameters and the growth journey for India is Sanjeev Sanyal, Principal Economic Advisor, Government of India. Mr. Sanyal, thanks very much for taking time out, sir, this afternoon. I want to first begin by asking you, India is positioned and primed to be an emerging market leader. Various brokerages are saying so. A lot of surveys are saying so. How do you see India positioned by 2030? Since we're discussing India at 2030, I want to begin by asking, how do you see and where do you see India headed by the end of the decade, sir?
Well, I mean, we, as you yourself pointed out, we are already the fifth largest economy in the world in dollar terms, and in PPP terms, we are the third largest economy already. Now, the next two economies in that chain are Germany, so we are at about $3.8 trillion economy in the last financial year. So Germany is at about 4.3 trillion, and Japan is at about 4.9 trillion. And so we expect that we will probably go past Germany in about 18 months to 24 months' time. And then probably go past Japan around about 2028. So, the fact that we will surplus them suggests that we will, that from an arithmetic perspective is now more or less inevitable unless there is a major unexpected shock of some sort. But I would like to make a few caveats here that we will remain, in per capita terms, still a very poor country. So do remember that. Mm-hmm. And also that the number one and number two largest economies on the world are much, much larger. So the US is about $24 trillion economy, and Japan and China is about $19 trillion economy. So even when we go past Japan and become a $5 trillion economy, we'll still be long distance short of the top two. Nonetheless, it will be a big, landmark for us, in multiple ways. So that's a good thing.
Right. Yes, Krishna.
Right. I want to ask, as we celebrate, this Independence Day, and as the Prime Minister has often spoken and reiterated the Amrit Kal that we are in, that we are at the beginning of this Amrit Kal that we are in. Talk to us. You were talking about the per capita income. There is even estimates that that the per capita income figure could also see a rise as we hit the year 2030, and for us to become a proper middle income economy, so to speak. And that itself, sort of sets so many Indians and so many parts of India financially free in that sense.
No, there's no doubt that we are becoming a middle income country. There's no doubt that per capita incomes are also rising. So it's not like they are not rising. They're just that it's from very low levels. Nevertheless, even the levels that we have already seen have led to, as the Niti Aayog's recent report suggested, over 100 million people were pulled out of poverty in just the last few years. So that process will continue. Extreme poverty will drop sharply with even as our per capita income hit somewhere in the 4,000 range. It will very, very significantly, maybe not entirely disappear, but it will become a very small proportion of the population. So in that sense, I would argue that by 2030, as our per capita income begins to hit levels where this very extreme form of deprivation becomes a thing of the past, we are the world's third largest economy, not just in PPP terms, but in proper nominal US dollar terms. Certainly our position in the world will be at a much higher place in every which way.
Mr. Sanyal, you mentioned an important figure of $4,000 per capita income by 2030. That, of course, is the prediction. How happy and satisfied are you with that figure, given you yourself pointed at some of the caveats, which is the inequality in this country? While we've pulled 100 million people out of poverty, it still so appears that large volume of that money and that resource rests primarily with well-off people. So inequality seems to be...
That's actually not quite true. I mean,
okay.
Of course, there is inequality in the country, but our real problem is not inequality, it's absolute poverty. Mm-hmm. And I think this diversion of attention to inequality unfortunately dilutes the real issue. The real issue is that a very large number of people in our country are poor in absolute terms, and the real attention should be to remove that absolute level of poverty. What happens is this, going into this inequality debate and Gini coefficients, etc. Yes, there is inequality, no doubt about it. And, but the real problem is absolute poverty, and we have to focus on getting that down.
All right. Another concern for the government and for RBI continues to be inflation, which has been revised upward to 5.4% for financial year 24 from 5.1%. How important and significant a problem do you think inflation will be? A lot of people, of course, continue to talk about, especially these days, continue to talk about vegetable inflation, pulses inflation. How significant a challenge do you think inflation will be in weeks and months to come, sir?
Well, I agree with the RBI's assessment of the situation. I mean, inflation, right now, there is no underlying inflation, but the fact of the matter is we have this problem with spiky vegetable prices, something I wrote about in the 2022 economic survey as well. And the ultimate solution to that is to make changes in our farm policies. But that's a longer debate to be had. I mean, for the time being, until we have these cold chains developed and so on, we will have these spikes in vegetable prices. But in general, there is no underlying long-term pressure on inflation in this country. Inflation is in the 2 to 6% target range. And as far as I can tell, the sort of underlying core inflation, if anything, continues to be well behaved. Remember, wholesale prices are still in negative territory. So in that sense, that I don't think this is a sustained inflation problem. We do have a vegetable price spike problem, and this obviously, the weather patterns and so on have an impact on that. And we do have a agricultural cold chain problem, which is something that we have been debating and discussing for a while.
Right. Also, I want to ask, as an economy, the predictions are that India is going to be anywhere between $6 trillion to now $10 trillion by the year 2030. I want to help us understand, like for us to reach that figure from here on, what are the factors that are going to prove crucial? And I want your own personal take on where does it lie? Is it $6 trillion or $10 trillion?
Well, I'm not in the game of trying to predict these numbers. As I said right at the beginning, we are somewhere around a little short of $4 trillion right now. By the end of this financial year, we will be probably a little bit above $4 trillion. And I think as I said, we'll probably go past Germany's $4.3 trillion in about 18 months or 24 months at most. And then we will go past Japan's 4.9. So we'll be about $5 trillion economy by 27, 28 time frame. It's a little bit behind schedule from what we had originally wanted for a $5 trillion economy, but then we lost 2 years in the COVID episode. So so that we had to make up. So we will make it nonetheless to the $5 trillion economy by about 27, 28. And then we will be somewhat higher than that, depending on what the growth rates and circumstances of that time are. Somewhere between 6 and 10. I mean, you could put a number yourself, depending on what your beliefs are about the global growth. I think one important thing people keep forgetting is that while India's own growth dynamic has dramatically improved in recent years, in the end, sustaining very high growth rates can only be done under circumstances where the global demand is strong. Because if we are just growing on our own basis, then remember, we will generate imports. And if the rest of the world is not growing, we can't export at the same pace. And so our current account will not be able to deal with this. So our current pace of somewhere in the 6.5%, 7% range is, I think, what we can sustain under the current weak global demand situation. Now, these things go in cycles, as you know. There will be a time when you will get global growth being more robust and global demand being more robust. Under those circumstances, India's growth can easily go up to 8% plus, maybe.
All right.
And, so then it's a question of what is the compounding that you see. The whole discussion we are happening really is about compounding.
Right.
And when you begin to compound a real growth rate of somewhere in the range of 8%, and remember, in nominal terms, that is over 10% because, uh, depending on what you think inflation will be. So you're compounding it over in double digits. And that is basically what China does as well. It compounded in double digits over periods of time.
Mr. Sanyal, you briefly touched upon global economic scenario, a lot of uncertainty that continues to persist. A lot of it is not in India's control, as a result of which we've seen exports decline, but we've also seen imports decline. Net, the current account deficit has been narrowed in the month of May. Figures are still coming out for the month of June. How is the import-export scenario looking like to you, especially on the back of the fact that India has been pushing for Make in India, and as some would say, rather aggressively?
See, Make in India is a structural effort. So it's about investing in our supply side, whether it is in our infrastructure or in our domestic production capabilities and so on. However, the point you are making is a much more cyclical issue, which is that domestic demand is doing well, but external demand is clearly shrinking, and it's nothing to do with India. You can look at China's exports and imports numbers, they've just crashed. And this has happened to every other country. Our own merchandise export numbers have also declined very significantly. So I think that is something that is not quite in our control. Now, yes, along with the exports declining, imports have also declined because the prices of many commodities have come off. Now, I mean, sure, that's good from a current account stability perspective, but from a growth perspective, clearly exports is not really helping at this point in time. Mm-hmm. And as I have said repeatedly, the 6.5 to 7% growth rate that we currently have is a very good growth rate under the circumstances. Now, there are people who will say that, okay, we should push for even faster growth. Well, I would caution against doing that under the current circumstances where external demand is this weak. There will be a time when the highway is clearer, and that's when you should press the accelerator. Meanwhile, you should keep investing in our supply side, keep building domestic capabilities, build up our infrastructure, and so on. Because when the good times come, there is usually very little time to respond at that time. So you need to have built up our domestic capabilities for that time ahead of that point in the cycle. So, I mean, the main point I'm making is do not confuse short-term cyclical sort of deviations from what we need to do in the long term in the supply side.
Right, and I think my colleague Krishna is really keen on asking more questions about demand side, supply side, and more importantly on manufacturing. But before I pass on the mic to Krishna, I have a quick question, and this is on the basis of news that is building up on imports of items, electronic goods, PCs, laptops, palm tops, now cameras and printers. We've seen in the past couple of days, sirs, that there have been import restrictions on a variety of these items. Essentially, industry and industries in fact spoken to. I suppose the government has also asked government to perhaps push back these import restrictions, which could be harmful in the short run, could also see prices of a lot of electronics item going up. I want to know your view on these import restrictions, sir, which seem to be now very frequent, but at the same time there is a pushback that we are seeing even from government side, where the rollout is either imminent and then that's pushed back to 3 months from now. What is your view on the import restrictions that we are seeing now every second or fourth day on various other items, sir?
So, I mean, you can have these tactical kind of restrictions for short periods of time in order to support growth in a targeted area, particularly given the global situation, because you do want to build up maybe capabilities in certain areas. But yeah, I mean, I agree with those who say that this is not a long-term solution. You can give a one-time boost by doing this. Longer term, you will end up with the ambassador car problem. So, import restrictions and licensing work at best if it's targeted and for short periods of time. In the longer run, you have to have the capacity to compete in the rest of the world.
Right, Sanal, the one thing I wanted to ask you is certainly, we are in an uncertain environment. We're seeing a slowdown in the markets, developed markets across the world, but India is steaming on with its ambitious targets to reach by the year 2030, and the consensus is always that it will be consumption driven. This Indian growth over the course of the decade will be consumption driven, and there are concerns over rural consumption and urban consumption both growing at a handsome pace. So I want you to help us understand what will be the challenges that India will have to overcome in achieving this consumption driven growth.
I will disagree with you. I don't think that we have a uniquely consumption driven model. Our model is, India is a moderately high investment country. We have a 30% of GDP is investment. We are dependent on exports, particularly services exports in recent years have done particularly well. So yes, having a large domestic market and domestic demand, both investment and consumption are important. But this idea that somehow we can grow by generating just domestic demand is not quite correct. We will need external demand, and we do need investment-driven growth as well. So I don't agree with this idea that some economists try to push that India is some unique consumption-driven model. It's not the case. You need to balance all these elements out: exports, investment, and consumption. And the very high periods of growth historically have always been driven by the consumption and exports, the exports and investment part of the equation, not by the consumption part of the equation. So consumption is a good baseline thing that provides certain amount of cushion maybe when things go a little difficult. But in the end, if you want high growth over long periods of time, it will be investment and export driven. So this is why I keep going back to the point that we should not attempt to use a demand-driven growth model in the longer run, because it runs out of juice very quickly, because your current account begins to generate very large deficits. Mm-hmm. So I keep coming back to the point is that just because there is currently an issue with external demand does not mean that we suddenly begin to invent a sort of new model for ourselves. There is no other new model. We just happen to have a good internal market right now, which is good, which gives us a cushion. But if you want 8% plus GDP growth rate, all the engines have to fire, which includes exports and investments. Right now, we have domestic investments are doing decently well, so is consumption, so good. We are getting 6.5%, 7% growth. But that extra kick is only going to come under circumstances where the global global demand is good. And trying to force it artificially using domestic demand is not a good idea.
Okay. So in the short run, Mr. Sanyal, while global demand is not looking too good at the moment, what according to you should be the growth drivers? What exactly is government focusing on? Because as you rightly pointed out, until the road becomes clear, the pathway becomes clear, it's important for us to start investing. We've not seen a lot of investment come in from private sector. Would you agree with that analogy?
Not quite. So the fact that we are seeing 6.5 to 7% GDP growth rate at a time when clearly global drivers are not conducive is partly because domestic demand is actually decently good. And this is true for investment as well. So, of course, there's part of it is government-driven investment in infrastructure. But it is also true that you are seeing significant revival in private sector investment. This is true of real estate. You are seeing in private investment, you're seeing an FDI also is doing decently well. So there is investment going on. So this idea that there is no private investment, I don't quite agree with. There is a lot of revival of private investment, either already on the way or will shortly be there from what we can gather. There's also a lot of demand for services of all kinds. So you will see the domestic PLI that you saw, all the measurements are red hot, well over 60. So reading over 50 usually suggests strong demand and orders in the PLI, the PMI, the monthly purchasing managers index. And our index is over 60, so which is red hot. So demand is good domestically, and I think that is good enough for a 6.5 to 7% GDP growth rate, which, as I said, is a very good growth rate under the circumstances. This should not in any way mean that we should take our eye off the macroeconomic stability indicators and try to artificially boost growth. You know, somewhere 6.5 to 7%, very good. Now, global cycles do turn, and when that cycle turns, we should be ready. And that requires us, of course, to, make sure our investment, our infrastructure, our ease of doing business, and all of these things are taken care of, so that as and when the circumstances turn, as they will at some point, we are in a position then to ramp up growth to over 8%, which I think for the very first time, our supply side is capable of sustaining over periods of time, because our infrastructure is now radically better. Our banks have been cleaned up and our financial capabilities are radically better. So we can sustain those 8% GDP growth rates when the circumstances are right.
Right. If I were to ask you, going forward, what would be the big challenge? I'm going back to the oldest debate possible in a situation like this, which is inflation versus growth. We have growth targets, ambitious growth targets, which we can achieve over the course of the next 6 to 7 years. And then there is inflation that continues to pose challenges. We are in a pause of a rate hike cycle. So talk to us, in the way forward to 2030. How do you think this debate should ideally pan out between inflation versus growth?
So this will have to be the last question, because I have to go to another meeting. But let me say that we are very clear about this and that's the point I've made even in the last 20 minutes, that we are macroeconomic conservatives. We will not sacrifice macroeconomic stability for a few percentage points here or there of growth. We showed that even during COVID, we maintained macroeconomic stability, did we not? So that's the point I'm making to you. We will maintain inflation in the 2 to 6% range. The Reserve Bank is clear about it. We are clear about it in the government. Let me say that continues to be the case.
All right, so stability over growth, that's the word coming in. Mr. Sanjeev Sanyal, thanks very much, sir, for taking time out this afternoon, for speaking to TV9, Newsline Plus in general. And we are, of course, celebrating 76 years of independence. The focus remains on growth that is organically driven as opposed to externally pushed. And of course, that's the big message coming in from Mr. Sanyal.
No, I think you misunderstood what I'm saying. I said it should be organically driven, and when the circumstances are right, externally driven. It should not be artificially demand managed. That's the point. Do not pump demand artificially. Keep the growth growing. 6.5 to 7% is a perfectly good growth rate. Artificially trying to pump it past that range when external situation is not good is not a great idea. The time for getting growth going at 8% will also come, but in those circumstances will be there. Our supply side is capable of doing it organically as well.
Okay, so no artificial tinkering, if that's the message I can take away from that conversation. Mr. Sanyal, thanks very much, sir, for taking time out this afternoon and for joining us on this discussion.
Thank you.
Moving on, the Securities and Exchange Board of India has asked the Supreme Court for 15 days extension to complete its inquiry into a report by US-based Hindenburg Research, which accused the Adani Group, and I quote, of stock manipulation and counting fraud schemes over the course of decades. Stating that it has made substantial progress in the case, markets regulator today filed an application with the Supreme Court seeking 15 more days to submit its report. The regulator in its findings said that the investigation has progressed substantially, but due to pending probes on certain transactions, it would be needing more time in the interest of justice, at least 15 more days to file its final report. To discuss what SEBI has said in Supreme Court, joining us in the studio is my colleague Mr. Bagaria is here. My colleague Krishna Kumar continues to be here. I want to come to you, Ashok, first. What exactly is SEBI saying?
Well, basically, SEBI is telling the Supreme Court of India that firstly, give us 15 more days to complete our investigations into the allegations of market manipulations and stock price manipulation by Adani Group of companies. Number one. Now, these allegations were made by US short seller Hindenburg in its report published in January earlier this year. Now, Supreme Court had stepped in because there were a few PILs filed in the Supreme Court. Supreme Court had set up a committee. One committee was a Supreme Court appointed committee with a larger mandate to look at the whole scale market manipulation and what steps needed to be taken to contain such kind of recurrences, number one. The second thing they did was that this committee, which was formed under the chairmanship of former Supreme Court Judge Justice Sapre, the court also asked SEBI to look into these allegations, specific allegations and specific cases, and said that you will also give us a report on this matter. Now, originally these committees were formed in the month of March. Then subsequently in May, SEBI comes again to the Supreme Court of India, says that we want a 6-month extension because we will not be able to complete our investigation in such a short period of time. Now, last time the court granted them an extension and said August 14th is going to be the time by which you will complete your investigation. And now what we are witnessing today again is that SEBI again has come to the court and saying that please give us 15 more days time to complete our investigation. So this is where the matters stand as of today.
The only thing I wanted to ask you immediately on that note is that how does the Supreme Court view the situation when the market regulator of the country, especially the amount of news that has been generated in the last 6-7 months and it needs another 15 days, does the court take kindly to these things?
Well, this time around earlier, Krishna, this court had not granted them their wish. They had sought a 6-month extension and the court had said, no, you complete your investigations by August 14th and that will be all what we're going to do. But this time around, it looks that SEBI has sought an extension of just 2 weeks, that is 15 days. So 14 or plus 1 more day to complete investigations, and it looks like when the matter is taken up, the court will consider the request and say, okay, heavens are not going to fall if we grant you 2 weeks more time to complete your investigations. And moreover, SEBI in its application is saying that there are 7 specific instances they have been investigating. Of the 7 cases that they have been investigating, the investigations are almost at a very advanced stage in 5 instances. In 1 instances, they might take a little more time because they have sought assistance of foreign agencies, and by the time the assistance comes, they might possibly have to look into it. And in the 7th case, they are saying that they have written to the authorities seeking sanction or appropriate directions to file their report. So this is where the matters stand at present, and we'll see. It looks to me that this time around SEBI could be given this 2 weeks extension.
All right, but there's no confirmation on that, Justice.
No, that's my guesswork, because as I said earlier, that the courts have waited for almost 8 months now because the report first came out in January. And today we are in August, it's almost 8 months. The courts have waited for that time. Another 2 weeks is not going to harm anybody's case. And this time around, the SEBI is saying that we are almost in the final stages of compiling our report. So the court will, it looks like that the court could grant them 2 weeks more time.
Yeah, exactly. They asked for 6 months. The court said, no way, Jose. But now they ask for 2 weeks. which is still a large possibility. So, you know, the next 2 weeks are going to be extremely crucial, and which basically means that come the 28th of August, or by the end of the month, the 30th of August, we're going to know the details of that SEBI investigation, one way or the other.
One way or the other, absolutely. But on the back of that news, a lot of stocks from Adani Group of companies are down today.
The whole pack, in fact.
Let's quickly pull up that stock chart, and we know they have fallen
All
by
Adani
as
Group
much as 2 to 4%.
As far as Monday's trading session is concerned, correct, because Tuesday is Independence Day, and Tuesday the market's closed. So Monday's close, you know,
Stocks are down 2 to 4%.
2 to 4% across the board. They're off the day's low. They were lower. Some stocks were down over 4%, nearly 4% for the day, but they're off their day's lows. But still, it's a sea of red as far as the Adani Group stocks are concerned. So all eyes on how the market even receives this piece of news that the market regulator, SEBI, has asked for a 2-week extension to file their final report on investigations into Hindenburg's allegations on Adani stocks. So we'll have to wait and watch how the markets react come Wednesday morning.
Come Wednesday morning, remember it's an off for the markets on Tuesday, so we'll have to of course wait and watch out for whether Adani stocks are going to recuperate or not. But remember, this also comes on the back of that crucial piece of information that came out on Saturday, which is the auditor for Adani resigning. Deloitte resigned, citing some transactions that they had flagged, that were flagged in Hindenburg report that they wanted to go over. Adani said, no, your mandate is limited to Adani ports and SEZs, and therefore you'll not be allowed further to carry on with the audit for other group companies. And the resignation that has in fact not just hit market sentiments, but also a lot of speculation rife now once again in the markets, for it appears that the ghost of Hindenburg has come back to haunt Adani.
Looks like it, because this is probably the second biggest piece of news since the Hindenburg report in itself came out. Like the way the stocks have reacted, because this is Deloitte, their official auditor, now officially exiting the entire Adani Group. And Adani Group claims that they exited simply because they were not going to get the mandate for other group companies to be their auditor. So this news certainly creating waves for all the wrong reasons. Big news since the Hindenburg, the biggest piece of news since the Hindenburg report came out. So as I said, the markets not receiving it well at all because of the way Adani stocks traded on Monday. First trading session since both pieces of news are in the fray, be it the SEBI filing its final report into the investigations, and of course Deloitte exiting as Adani Ports' auditor. So Wednesday morning we'll have to see if the Adani stocks continue to fall further, deeper, because the kind of fall that Adani stocks witnessed on Monday was the kind of fall that Adani stocks witnessed during the time of when the Hindenburg report came out in January, February time. They were losing 4%, 3% on a daily basis. So immediately after Deloitte stepped out and news of SEBI's final investigation report coming out, Adani stocks are down 3 to 4% in the market. Not good signs at all. We'll have to wait and watch how Wednesday morning pans out, Shweta.
Well, of course, have to wait and watch out for how Wednesday morning pans out for Adani Group stocks. But as my colleague pointed out there, stocks down 2 to 4%, worst possible performance since that crucial, damning Hindenburg report. Adani there losing a substantial part, and all group companies, in fact, on your screens, losing a substantial part of its market cap today. But I think
you
with
never
that,
know, the fact that they have a 2-week breather, fact of the matter is that we
don't
know the final findings of SEBI's investigations into Hindenburg's claims. So
the fortunes could tilt either ways for
exactly
Adani.
The report. What if the two are clear?
If it's a clean sheet, good for Adani.
Then it means that all these losses, all this sea of red that you're witnessing, could turn to a sea of green immediately.
Absolutely.
But if there is no clean sheet, then are we looking at further downsides to Adani stocks? Bear in mind, Adani stocks have recovered quite a bit since their huge steep, cataclysmic fall in January, February of this year. They have recovered a lot. They have recovered, in fact, everything, and they're back to where they were before Hindenburg reports claim. And now that they're back to their original levels, the fresh piece of news that Deloitte has exited the company as an auditor has hit them again hard, and of course the fact that this sort of Damocles sword that's hanging over them, the SEBI investigation, what is the finality on it, will have a lot to say.
2 weeks later.
Yes.
In fact, we'll have a lot to say 2 weeks later, but I think with that it's a wrap on this edition. But after the break, COVID-19, remember, had a debilitating impact on Indian economy and SMEs in particular. This series that follows will chronicle the trials and tribulations that SMEs underwent and how they managed to overcome their challenges. Watch Small is Big, a special show from News 9+.
Pakistan is actually genociding Baloch people. So being Baloch is a crime. If you are a Baloch, it means in the eyes of Pakistan, you don't have any right to live.
The Chinese and Pakistanis are colonizing the Baloch and